Okay, we are live. Hello, everyone. Today we're
Hi
excited
there.
to have Joanne O'Keefe, a mortgage broker from our very own William Raveis, to discuss what's been going on in the market and give us some insight and expertise on the topic of mortgages. So thank you, Joanne. We're thrilled to have you.
Oh, thanks for having me. Good to be here. Good to see you guys.
Yeah. So Joanne, do you mind just giving us a little update on what's been going on, what you're seeing?
Yeah, absolutely. So, I mean, interest rates certainly since beginning of the year have gone up substantially. There's no doubt about it. We've seen a little bit of leveling off over the past couple of days, I have to say. So now we're not knocking on the door of 6% anymore. Now we're sort of comfortably in the mid 5 region, which is it's allowed people to get their breath a little bit. Whether or not we'll see that move down, I don't know. I mean, it depends on economic indicators that are coming up. And, as we've discussed before, I mean, the big thing that's moving the economy one way or the other right now, and interest rates and everything else, is the inflation figures. So as the CPI was it's a consumer indication of where inflation is, came out in June, that was the catalyst for the big rate increase that was 3/4 of a point on the Fed funds, which mortgage rates are not tied to that directly, but that certainly affects what happens to interest rates, in the future, sort of a lagging indicator. So, but it's not point for point. So when the Fed funds went up by 3/4 of a point, mortgage rates didn't go up by 3/4 of a point, but they did go up by 3/8 or so. But they've settled down since then, and any global event can certainly change what happens in the market. If things heat up in Ukraine, or if we have a natural disaster, all these things can affect the market. But right now, what's driving most of the economy right now is really jobs and inflation. So, like I said, interest rates have settled down a little bit more, and we're in the mid 5s actually right now for conforming, and that would be a Fannie Mae loan. For a single family that's less than 647,200. We are seeing interest rates that are much more favorable on the jumbo end. And I mean, those interest rates are in the high 4s. So it's a big difference.
Oh, wow.
Yeah. So, and I think what's happening there is there's no secondary market. There's no Fannie Mae securitization on loans that are these jumbo size that are over that Fannie Mae loan limit. So what's happening with those is they're really being funded by banks, and banks are holding on to those and keeping them in their own portfolio. So because they like having a yield on a 30-year loan, which historically can stay on the books for about 8 years, is really the statistic that they have, that a person might hold on to either their home or their loan for about 8 years. So they're thinking that that's a good return if you have an interest rate over 4.75 or over 4.5 for that period of time. That's attractive to some banks, but they only want the larger loans.
Got it. Joanne, I recently had a client tell me that they were going to be looking into a 10-year ARM instead of the 30-year fixed. So can you kind of just talk to everybody about what is an ARM, what are the advantages and disadvantages of it, and also, is it worth it to look at that right now?
Sure. I mean, it's certainly, so an adjustable rate mortgage is, and these are ordinary traditional adjustable rate mortgages. These are not the adjustable rates that we had back in 2006 and 2007 that really sunk the economy. If you have a traditional 10-1 ARM or 5-1 ARM, 7-1 ARM, your payment is going to pay principal and interest just as it would on a 30-year fixed rate, and your interest rate would be set for a certain period of time. So there's no risk of negative amortization. Your payment is being amortized just as it would be on a 30-year fixed rate. So the difference would be, if you have a 10-1 ARM, your interest rate would be fixed for the first 10 years of the loan. It's amortized and your payments are calculated over a 30-year period of time, but the interest rate itself, the note rate, is fixed only for the first 10 years. And then after that, you're subject to a rate change. And it is tied to an index, and the index could be the 1-year Treasury bill. It could be the SOFI, which is the secured overnight financial rate. which is a little bit more popular now. And they add a margin to that, and the margin can be anywhere from 2.5 to 2.75%. And that's how your interest rate would be set. And it would be set, it would be subject to reset each year for the remaining 20 years of the loan. So you'd have to be sort of comfortable with the fact that you will have an interest rate that's going to be variable for a number of years. A 10-1 might be attractive to somebody who says, I'm only going to be in the home for, 8 years or up to 10 years. And they can take advantage of a little bit lower interest rate. The spread right now between a midterm adjustable, which is what I would term a 5-1, a 7-1, or a 10-1, the spread is not huge between that and a fixed rate right now. It might be about 0.5%, but that might be enough for somebody to take a look at it if they're really certain that they're only going to be in the property for a shorter period of time. But the ARMs today are traditional ARMs. They're not the interest-only ARMs or negative AM ARMs that we had in the past, and they don't have prepayment penalties or anything like that. So they're pretty safe and sound, instruments, and they're worth looking at. But I have to say, the majority of my clients, 90% or more, are still staying with the 30-year fixed or a 20-year fixed.
That was my next question. What are you seeing most of?
Yeah, so definitely the 30-year fixed rate. If somebody is refinancing, for example, I had just have somebody, and nobody's really refinancing unless they really have to at this point, for reasons that, they need to take cash out, or there's some life event where they need to. And rather than extend their term on their loan, they may have had a 30-year loan that they've already paid 5 years into it. They'll choose a 20-year term, and the interest rate is slightly better on that. But for the most part, the 30-year is really what I'm seeing the most of. People will price them out, Mackenzie, like you said, and then it'll give them payments for both and pros and cons of each one. And it seems like people do still settle down to the 30-year fix. I saw a statistic the other day. They said from, I think it was June of last year to June of this year, there's been an increase in ARM production of about 10%, which is, that's higher than it has been in the past. And that's because of the dramatic rate increases that we have seen. And some people, if they know they're only going to be there for a little while, then they'll do it.
Yeah, even just that statistic from last year to now. We've been seeing a lot of buyers that have experienced buyer fatigue and decided to take a break. Have you been experiencing with that with any of your clients as well?
Definitely, yeah. But I have to say, I think people in the recent past, we were speaking before, I think people are starting to see prices sort of maybe level out a little bit, maybe a little bit less competition. And I've really kept after my folks too, and I send them, regular updates of interest rates and so forth, and try to keep my finger on the pulse of what they're looking to do. So I have found that more of them are coming back and they're winning bids, which is great. Some people have been in the market, as you guys know, because you deal with a lot of buyers, for a year or more, and they've lost out on 6 or 7 property. And you're right, they do have fatigue and they're ready to walk away. But I think they feel a little bit more energized now that there's a little bit more inventory, and the interest rates are not skyrocketing over 6% as they were even a couple of weeks ago. So is that what you're finding too?
Yes.
But I want to ask a question. Actually, kind of going off this. So, Joanne, what is your advice to the first-time homebuyer that's still renting, and maybe they're in the city, they're in Boston with kind of a higher rent, and maybe they had a rent increase from last year to this year? I know a lot of my friends that were living in the Seaport that definitely happened.
Yes,
they got a good COVID deal, and it went up like a good percentage. So I guess, what's your advice to a first-time homebuyer that's kind of in that situation, and who's kind of still sitting on the sidelines because of where rates are at right now and where the projected rate hikes are supposed to be? What would you advise to them, to keep renting, or to if they do have the means to be able to buy and can afford the monthly payment, should they be doing that, even if they're just beginning their search right now?
Well, they should certainly take a look and compare what it looks like. I mean, you're absolutely right. We've seen a lot of huge rent increases in the city and even the suburbs. I mean, to rent an apartment or a home in Andover is just astronomical right now. And in most instances, you could purchase something and pay less, and then start building equity right away. Sometimes the big hurdle to get over is the down payment. And, there are lots of programs out there. There's a mass housing program that is fantastic that has a down payment assistance program that goes along with it. So you could put as little as 2% down between the first and second mortgage, sometimes as little as 1.5%. There are income limits on it, and you do have to have decent credit. But that's a really good program. And certainly with a conforming Fannie Mae loan, you can also put 3 to 5% down as well. So, and even with paying private mortgage insurance, sometimes it's less than what you're going to be faced with for rent in this area. And they're not calling for many changes for the rent to start coming down either. And I think with the rent continuing to go up and housing prices stabilizing a little bit, it could be a good time to look at it.
I think too, the thing with rent is that you're not building any equity like whatsoever at all. Like you
Correct.
are just, throwing that money out the window every single month. And I think for the people that either, can't get to the down payment that they want, or, can't afford the monthly payments or whatever, or if they just have like a good deal with their rental, then maybe, right now it's okay to kind of wait it out and do that. But I like to remember that at the end of the day, you can't ever really time the market. And that's a lot of the advice that I give to my buyers, is that if they're ready to go out and buy and they need that, the space, then it shouldn't really matter so much like what the rate is, because, once it does go back down, or, if it does, then you can always refi down the road. And as long as you can, afford those payments, you're comfortable with those payments, and you're also, starting to build equity, which is great.
No, that is very true. And I think there's other opportunities for down payment too. I mean, a lot of times people are not aware that they can get, 100% gift too for down payments, which, it's not an option for everybody, but
right.
Believe it or not, when people start looking at homes, people do come out of the woodwork, and, aunts and uncles and parents, and they want to help. And it's a great way for a first-time home buyer to really get over that hurdle and be able to get into a home, even if they were to, give money towards closing costs, which closing costs can be expensive. And, beyond your 5% down payment, you could have closing costs that would be $8,000 to $10,000. And if you had a parent or a relative that was able to gift those funds to you, makes a big difference.
Yeah, definitely. And so when you say that they can refinance down the road, can you talk a little bit more about like how that works and what your options could be? Because even last year it was 10% less, and now it's 10% more. If it were to go down from here, how would that work for buying?
Yeah, so it would affect the equity in your home for certain if home prices did go down. And refinances in general are a little bit more stringent in terms of the equity that you need to pull a mortgage out. So on a purchase, you can do as little as 3 or 5%. On a refinance, typically they want to see that you have 10% equity. So that's one thing to consider for sure. But there's, I've been doing this for a long time. Interest rates are very cyclical. I mean, there's probably going to be an opportunity to refinance that mortgage in the next 3, 4, 5 years. It's just waiting for that window of opportunity. And again, if the stars align and the home prices are also appreciating or at least staying the same, you should be able to do that.
Great. So just going to ask, I just blanked on my question. I have 2, but I'll start with this one first. Where do you think rates are going to be by the end of this year?
Oh, God. It is tough to say. I mean, the Fed meets again middle of July. The inflation number, the is going to be a big one that's going to move markets one way or the other, that and the job figures. I think the common thread between all of this is that they're saying that the Fed is really wanting to keep a fast hold on inflation. They really don't want it to get out of control. So if we see numbers again in July that show that inflation is quite high, then we could see another 3/4 of a point increase, and we'll see mortgage rates go up. So it's tough to say. I've been doing this for a very long time. I'm not an economist. I try to be educated on all the economic news that comes out, but I can't even begin to guess where they would be. I don't really think that they're going to go down from here. I think we're probably going to be living in a range of, between low 5s to at least 6% or so for the next several months anyways. But that is purely speculation because I don't know. It's really tough to know.
It's kind of like when somebody asks us as realtors, where do you think the market will be in a few months? And, how much do you think that you would be able to get for my house like right now versus like if I did X, Y, and Z to it and waited until this time, because none of us have a crystal globe, right? And we can't afford to sell. So,
we just try to.
History.
Pardon me?
It's definitely the same thing in your industry. Mackenzie just hit you with the question.
It is. It absolutely is. And I get the question a lot. And believe me, I mean, people want to know. And all I can do is I can pass on the knowledge that I have and just information and data like you guys have. We just pass that information on. And at the end of the day, like you said, it's a home purchase. You can't base it 100% on interest rates. You really can't, because you might have an opportunity to refinance that in the future. This is your home. This is a property that you want to live in, or even if it's an investment property and you want to be able to use it for cash flow reasons in the future. It's an emotional decision for sure. Right. And you can't base it 100% on where interest rates are.
Yeah, I feel like a lot of people do look to interest rates though. So
it's
interesting. And I always recommend just go talk with a mortgage broker and just see your options, because I think a lot of people just look at that rate and they're like, okay, they do the math and they're like, this is what I'm going to be paying. But like you said, there are so many more options that and buyers can take now.
Mm-hmm. Right. And I think too, it's all sort of, this is like the new normal now. Interest rates are not in the 3s anymore, and they're not going back there anytime soon. So let's, get with reality and see that they're in the mid-5s, and that's where it's going to stay. The other thing that's happened too, that I have found, especially with a lot of the younger clients that I have, is that their incomes have gone up. So they're getting higher bonuses, they're getting higher pay raises than they have in the past, because it is such a tight job market and people want to hold on to good workers. So they have a little bit more, disposable income to work with. So that's helping a little bit too. And I try to remind them that, look at what's gone on between the last couple of years. Your income has increased, in some cases, 10, 15%. So you're going to be able to put more money towards your mortgage payment.
Joanne, so I know, especially in our local area around here, for the past, 2 years, it's been very difficult to, within certain price points, to get offers accepted for buyers that, aren't 20, 25, 30% down or more. Are you starting to see that, you're doing more loans with the lower down payments, and not necessarily in this area, but just that, like that they're starting to actually get accepted? I'm curious.
Yes, I am. Absolutely. Yeah. So I've had a young couple that I've been working with for probably about 8 months now, and they've put a lot of offers in, and they are truly they're a 10% down couple. That's what they have to put down. They're extremely strong. They're well qualified for what they're looking to do, but that's their down payment. That's what they're working with. And they did get shut out of a lot of properties because of that. And each one, they try a different tactic, which, you guys are great at guiding your clients as to, what's the best thing to do in terms of contingencies, but still protecting the client. So they did finally get their offer accepted, and it was, they had to go over, but they weren't going any higher over than they were on the other offers. I just think that there's less competition for them and less cash buyers, I'm finding as well.
Yeah.
Are you guys seeing that too, or?
Yeah, I mean, in the heat of the spring market, there were definitely quite a few cash buyers that obviously that's attractive. But I think that it is giving the slower market is giving buyers some more hope, and I tell people it's not a bad thing that there's more inventory because even though we are seeing more inventory, the supply is still way lower than the amount of buyers out there. So,
Correct.
Yeah.
So what are you finding from like last year to this year so June of 2020 to June 2021, in terms of what's on the market percentage wise? Would you say it's about the same? Would you say it's higher now, lower now?
I think it really depends on the area, but I think between like Andover and North Andover, I'd say it's probably at a higher percentage. I remember, going into the MLS and being able to click like 5 towns and it only being like 30 homes between the 5 towns or 5 areas. I think that, now there's not like a ton. And I think that there's still certain houses that are experiencing, bidding wars, but it's not every single property anymore.
Mm-hmm.
They're still moving, but I think that for the most part, the day of putting it on market and then getting an offer within 4 days and having 30, 40 offers to choose from is just not really the norm anymore. I think it's I think inventory wise, I don't know percentage wise, how much we are. But I definitely notice that there's more out there and there's more that's, staying on the market. There's definitely some more price changes. We're also seeing a lot of people start to, cancel the listing and put it back on market, like with a newer price. And I think for the first time in a long time too, we're seeing some normal like seasonality in the market where, last summer and the summer before, like life wasn't, totally normal. So we couldn't go and really do a lot of things. And when we were doing things, there were so many restrictions put on us. So, it was sort of like, is it really worth it to go down to the Cape this weekend and, have to make all these reservations and only be able to sit outside with 4 people or 6 people or whatever else. So I think, now everyone's back to kind of enjoying life a little bit. And I know that everybody is planning their weekends right now, around going to look at houses.
Yeah.
Yeah. There was actually, our team, Jen, sends out a weekly report, and this was on Monday. So there were in Andover 44 homes on this week. And then last year at this time, there were 27. So we look at these stats regularly, and it's really interesting. We talk about it in our team meetings, like what's going on now versus last year. Because sometimes the average list price and the average sale price, comparing year to year, especially with the inflation rate, it can be a little hard to navigate there. But in terms of listings, there are more, I mean, not too many more, but
a good amount though.
Yeah. No, that's one of the things I love about William Raveis. The amount of data that they provide you with is amazing. It's a great tool for sure.
Definitely. What else? I think I probably know the answer to this already, but I will ask you anyways. Are you still seeing like a lot of people trying to invest right now? Like any like investors trying to do loans, or no, not really?
Yes. Yes. I am seeing a lot of people that are trying to purchase investment properties, but it's interesting. I don't know if all the people that are jumping into the market for that right now are necessarily qualified to do so. I mean, you have to put a larger down payment. You have to have flawless credit. It's not as easy to get an investment property. But for one reason or another, I definitely have seen a number of pre-approval requests for investment properties right now, 2 and 3 families. But I don't necessarily know if there's a lot on the market either. So what are you seeing in that regard?
I'm seeing some. I think overall, usually there's less multis or investment properties than there are, single family homes. But I do business out here in the suburbs, but also in the city as well.
I know, right.
And I think those ones in the city, I think it depends on the client that you're working with and what the buyer's looking for. And if they want something that's vacant, if they are looking to do work to something, or if they want something that has tenants in place. I think that right now at this time, I feel like, and it's just a fact that, when inflation is up, like real estate's just always a good place to put your money, like just, in the stock market and all that stuff. Like it's just so volatile that, and not to say yet, like, I don't feel like yet in this market, like you're really able to grab something for like a quote unquote, like really amazing deal. Like, I don't feel like I'm seeing things go for like having like a $100,000 price drop to then selling for like 100,000 underneath that or something like that. I think, it's evening out, it's leveling out. But, like we've talked about throughout this call, I sort of feel like things are just going to keep increasing, but not as this like crazy level that they have been. So to answer your question, I think that there are still a lot of investors, trying to lock up properties and doing 1031s still, because I don't think the status of that yet, right? Are 1031 still in play, or is there something right now going on with those that there may not be a future?
Right now, we're able to do them. Yeah. But I think people have to be very conscious of what the cash flow is going to look like. And the cash flow that we can use to qualify them for the loan too, because we're either going to have to go on a lease that's in place or the market analysis that comes from the appraisal. So, people that will go in unrealistically and say, well, I can rent this for $5,000 a month. Well, maybe you can, I don't know, but we have to go with reported rents in that area that are similar to the property. So you just have to it's more of a conservative approach to it, and people have to be aware of that. And again, looking at a 2, 3, 4 family property investment, you're going to have 25% down and good credit and reserves as well. So it's a big undertaking. It's a good education for people to at least call and find out too. So, sometimes that's all it is, going through the pre-approval process and seeing, maybe we need to save more money. Maybe we need to look at, less expensive properties and really investigate what the rent would look like.
Yes, it definitely can't hurt to just make a call and find out what's going on,
Right. Yeah.
Especially so many people are just, I'm just looking. And then they find something and they're not so it's better to know, definitely.
Yeah. And a pre-approval is good for, it's really good for 90 days and it's very easy to update it.
Right. Were you finding that in the spring market, you were dealing with a lot of clients that needed a pre-approval, like very last minute? I found this house, I really like it. Or were you more looking or working with long-term ones?
It was a mix, I would say. There were a lot that I have some of them been working with for a full year, so at least. And then others sort of, last minute, they, were panicking a little bit, I think, when they saw interest rates starting to, move up in a dramatic fashion, that they would be very kind of last minute. They'd see something come on and they'd want a pre-approval letter, which, in most cases we can do pretty quickly. But if somebody is self-employed, we really need to have some time to evaluate what their income looks like, because we do a full certified pre-approval. So we evaluate all the income information that comes in. So we'll have to look at business returns if they have those. We'll look at individual returns. over a 2-year period of time, and we need to average, and then we'd like to know year to date what, where they stand in terms of their business as well. So it takes a little bit longer for somebody that is self-employed.
All right. Well, thank you so much, Joanne, for
Yeah, you're welcome.
Talking with Leah and I.
Mm-hmm.
How can somebody get in touch with you if they have questions and if they want to have a conversation about mortgages?
Yeah, absolutely. They can email me. It's Joanne.OKeefe at Raveis.com, or they can call me. It's 978-314-1072.
Perfect. Thank you so much, Joanne.
No, it was really good talking to you guys. Good information on your side too, as always. You guys are terrific.
Thank you.
Thank
All right.
you.
All right. Bye.
Bye.
Bye-bye.
Take care.